Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's episode, we're actually going to be talking about how to find the best Forex pairs to trade. Okay, so if you've been trading for any period of time, uh, if you just got introduced to trading, then you're probably going to find out that there are lots and lots of instruments, currency pairs, and assets that you can trade. Okay. And this can easily get overwhelming for complete beginners because if you don't know which pair to trade or how to choose which pair to trade, then you're basically going to be struggling to find the best currency pairs to trade because you don't have any set of rules or criteria which is going to help you in deciding which currency pairs to trade. And that's why we're going to be talking about this very, very important topic in this week's episode of the ITU Forex class. Okay, so without wasting any more of your precious time, let's dive right into it. Okay, so I've got a couple of headings or a couple of categories that we're going to consider with regards to finding the currency pair which is best for you to trade. Okay, so depending on your level as a trader, if you're a beginner, if you're an intermediate trader, or if you're a professional, then the recommendations for which currency pairs you're advised to trade is going to differ. Okay, so first things first. Number one is what actually makes a good currency pair, or what actually makes a currency pair good to trade. Okay, what criteria, what things should be considered when you're about to select a good currency pair to trade? Well, number one is you need to consider or find currency pairs that have high liquidity and volatility, because as we talked about in the previous class, in last week's class, I told you that in trading, okay, you need a pair or whatever instrument you're trading, okay, you actually need it to move for you to make money. Because in forex trading, one of the most common ways that you would make money, in fact, a lot of beginners, this is the only way they know to make money through trading, is for you to buy an asset when it's cheap and then sell it when it gets to a price which is higher than the price you bought it at for a profit. Okay, but if you buy an asset when it's cheap and then instead of going up to give you an opportunity to sell it when it's at a higher price than the price you bought it to close with a profit, if it goes in the opposite direction and so you buy it at a higher price than the price which it currently sitting at, then that trade is going to cost you to incur a loss on the trade. Okay, cause you to incur a loss. Okay, so in this case, one of the most common ways that you need to use in order to make money through trading is for you to buy an instrument when it is cheap and then sell it when it is expensive, or for you to sell an instrument when it is expensive and then buy it back or cover your short, as we call it in the trading world, when it is cheap. Okay, that's one of the two ways you can make money through trading. So an example of what this would look like is, let me quickly show this to you. Okay, so you can see that this particular chart, for example, price was moving, it's kind of in a range, but there were times when it went down and there were times where it found support and it went up. And so for you to make money on this chart, this is just an example, okay, to drive home the point. You need to, for example, when it was at a high price like this, you would have needed to sell it when it was somewhere around here. And so when it moved down lower than the price where you sold the currency pair at, then this would have been a good place for you to close your short trading position with a profit. Okay, and then for you to make money for when this particular currency pair in this example went up, you would have needed to buy it when it was somewhere here, somewhere low, okay, at this kind of price point somewhere around here, and then you would have needed to close that long trading position when price would have reached somewhere around here. Okay, so now that you understand this, okay, let's go back to what we were talking about, which is liquidity and volatility. So liquidity, to help you understand what this is if you want to trade an instrument, or you want to sell, or you want to buy an instrument, and there's actually instant supply for that particular instrument. So to give you an example, let's say you were in the business of selling shoes. Okay, and so you bought a couple of shoes from the store or from the wholesaler or whatever the case might be. Let's say you bought like just 5 pair of shoes. Okay, and then you have a store in the market where you actually have access to people who are interested in buying all of this type of goods, and so you place those 5 shoes that you bought on display in your shop, in your store, in the market, and then people who are interested in it just come into the market and come to your store and they buy those shoes. And so you decide, okay, you know what, this is a very good what do you call it, this is a very good item because I bought 5 of them with a very good markup. So, and the market just gobbled it up within a very short period of time. All of the 5 shoes that I placed on display were bought by customers. Now, a wise businessman would go to the wholesaler and get more of those shoes, but he's not going to get those shoes in a proportion which is not wise to do. So for example, let's say you bought 5 at first and then the market just rushed it and bought everything within a very, very fast period of time. But it will not be wise for you to now go back to the wholesaler and instead of buying, just a little bit more, maybe you bought 5 the first time. Now you might decide to buy, maybe like 7 or 8 or at most maybe 10. Okay, to still test the market. And if people are still buying it, you continue upping your game little by little. It would be unwise for you to now go to that wholesaler and say, you know what, I'm going to buy all of my money that I'm doing business with. I'll liquidate it somehow. I'll turn it into cash, that I'm going to buy 10,000 pairs of these shoes. This same shoe, okay? I'm going to now buy 10,000 pairs of it. So let's assume that somehow the wholesaler is able to provide you all 10,000 pairs that you want of the shoes, and you fill the entire shop that you have in the market with that particular shoe. Now, the problem with this is you would have, let's say you have 10,000 pairs of those shoes, and in the state that you're in, okay, or in the particular locality that you are in, the people who are interested in buying that type of shoe are, maybe just a couple, at most, a couple of hundreds, if they're even up to that amount. So let's say at most, the people who are interested in buying that shoe and who can actually afford to buy that shoe are at most just, let's say, 500 people. And let's even assume that you're the only person selling that shoe in that entire state, or even in that entire country, for example, and you're not doing any online store selling or anything, you're just doing physical business for this particular shoe. Now, even if every single person who is interested in this shoe came to buy that shoe, then you'd still be left with around 9,500 pieces of those shoes. And so for those shoes that you have, that you cannot actually immediately convert those shoes to cash, then those shoes can be called in the market as illiquid. Because for you to convert those shoes to cash now that you need it, it's actually extremely difficult. If it was very easy for you to just take it to the market and everybody just bought it, it was easy to find buyers for that particular instrument, then that would be a liquid asset because there are instant people who are interested in that, buying that particular asset. But since if you don't have an instant customer base who want the entire thing that you're selling, then that's an illiquid asset. In Forex trading, this is seen as especially in the CFD world, like you wanted to place a trade because the market is so huge. I think around almost more than $5 trillion exchanges hands in the Forex market every single day. Even if you wanted to buy or sell millions worth of a currency, is as simple as just pressing a button and you have somebody on the other side of your trade take that particular trade, the other side of your trading position. Okay, so because of this, the Forex market is very, very liquid. But is it every single currency pair that is traded in the Forex market that is that liquid? Of course not. Especially the currencies that are very liquid are known as the majors. Currencies like the Euro USD, the GBP USD, USD JPY, all of these currencies, because they are the most heavily traded currencies, they are very liquid. So it's easy for you to buy or sell millions or however large the contract that you want to trade for that particular instrument. It's very easy for you to just get into the market with just clicking the click of a button. So they are liquid. Okay, and then volatile is what I explained here. They move because if a instrument that you're trading does not move, then it's almost impossible for you to make money from trading those instruments. You need movement, and that's volatility. So liquidity is for you to have somebody readily available to take the other side of your trade. So going back to the example that we used for these shoes, okay, let's assume the 10,000 pairs that you bought. As soon as you bought them, let's say you wanted to sell them back to the market, and there was a readily available buyer who would take all of those shoes from you and give you cash in exchange, then that would be a liquid instrument. The shoes would be very liquid because it's very easy for you to turn them into cash. But if it's difficult for you to find buyers for that particular shoe, for example, then it's not a liquid asset. Okay, that's just all it means. Liquidity means you have readily available buyers or sellers who are interested in taking the other side of your trading position, however big, however large the position you're trading, or however small it is. And volatility is the movement of that asset. And we need movement in trading. Whenever we're trading an instrument, we need movement to actually be able to either make money on a trade or quickly lose money on a trade. Like, we cannot win 100% of the trades we take. So just because based on our analysis, we see that a currency pair is about to go down and we sell it, this does not mean that every time we sell it, every single pair is going to go in our direction. Obviously, there are times when it will go in our favor and there are times when it will go against us. Okay, so this is just what it is. Now, this was the first criteria. Okay, now the second one is you need those currency pairs to actually be one of the majors. The reason is because when you're trading a major currency pair, because of the fact that they are very liquid and they tend to also be very, very volatile, brokers tend to offer the best trading conditions they can to attract people to trade those currency pairs with them. So if you're trading with a broker and he knows that the Euro USD, for example, they all know this, that the Euro USD currency pair is the most traded currency pair in the world, then to attract customers, because at the end of the day, each broker is trying to attract the business of traders, okay? So to attract as much traders as they can, they will try to offer you the lowest spreads, for example. In fact, there are accounts where they will not even charge you based on spreads. Your spreads will be almost zero, okay? But the broker is just literally going to be charging you, commissions and all of that based on the size of the position that you're trading, okay? So because of that, currency pairs like the majors, which are heavily traded, they tend to come with the best cost for traders through the charges that brokers will charge them. So if it's spreads, they would usually have the most competitive spreads. And if it's commissions, those commissions would also they tend to be the best for currency pairs which are traded the most, like the Euro USD, GBP USD, and USD JPY, for example, because they are the majors. On the other hand, currency pairs that are not traded as much, currency pairs like, for example, the USD against the South African rand. So it's going to be something like USD ZAR, or USD against the Singapore dollar, USD SGD, for example. Because they're not traded as much as the majors, they will tend to have a higher cost of trading. So maybe their spreads will be wider, a lot wider, and their commissions will be a lot more. So if you're somebody who's just getting started with trading, being able to even forecast what the market is going to do, and then doing that, at least, even if you don't need to be right as much as you're wrong in trading, because you can have a win rate which is lower than 50%. And as long as you're doing, you have a good risk to reward ratio and all of that, eventually you're still going to be able to make profit. So it's not about being right more than you're wrong. But let's say when you're right, you make more profit from your winning trades than the amount of money you lose when you're wrong. Okay, so you could be right less than the times that you're wrong. So what does this have to do with anything? Being in a situation where you are making enough profits from your winning trades than the money you lose on your losing trades is hard enough in and of itself than for you to now add onto that the fact that you're trading currency pairs which have very high spreads, which have very high commission costs, and all of that. So as much as possible, you want to put the odds of winning in your favor. And one of the ways to do that is to trade with a trading strategy that has an edge in the market that would help you to make more profits from your winning trades than the amount of money you lose from your losing trades, and also minimize your cost of trading as much as possible. And so this is by doing things like, trading currency pairs which have very good commissions and very good spreads, competitive spreads and competitive commissions. And if you are doing this, and trading currency pairs which are not as liquid or volatile because they are not heavily traded currency pairs, then you're putting yourself at a disadvantage. Okay, and that's why you want to trade the majors, especially if you're just starting out, because they will give you the best cost and all of that. Okay, and then the third thing is you want to avoid illiquid or exotic pairs until you're more experienced, which is exactly what we talked about here. You want to trade the majors and you want to avoid the illiquid pairs, which are not traded as much as the majors. Pairs like the ones I told you, the USD ZAR, which is the USD against the South African Rand, or the USD TRY, which is the USD against the Turkish Lira. Okay? These are all currency pairs that, even though they are traded, they are not traded as heavily as the majors in the market. And so they tend to come with a very high spread cost, tend to come with high commissions and all of that. Okay. And I even forgot one. If you're trading on an account which incurs swap fees or pays swap fees or all of that, these currency pairs, because they're exotic pairs, their swap costs tend to be very, very high. Abnormally high, more than what you'd usually have with the majors. Okay, so especially if you're just starting out, if you've done the hard part and you have a trading strategy that has an edge in the markets and all of those things, you don't want to put yourself at a disadvantage by trading pairs which have a very high cost of trading. By trading illiquid pairs which have high spreads or high commissions and all of that. You want to stick to the majors as much as you can. Okay, so second thing is you need to know which type of currency pair you're going to be trading. We've got the majors, we've got the minor pairs, and we've got the exotic pairs. Now, the major pairs, as you can see again, they're the most traded pairs. Examples of this would be the Euro USD, GBP USD, and the USD JPY, amongst a host of others. Okay, but they also not only are they the majors because they are the ones from the high countries, tier 1 countries or whatnot. They offer the lowest spreads. And they are more predictable because they have the most volatility and liquidity. They tend to move the most and they tend to move with precision. Okay, you could trade them without any problems. Does this mean if you have a trading strategy and you trade them, you're never going to have a losing trade? Of course not. And I keep telling you this because I want it to really stick to your minds that you can lose more trades than you win, but if you're doing everything else right, you have a good risk reward ratio and you're doing proper risk management, you're keeping your risk consistent, you're letting your your profitable trades hit their profit targets and all of this, then it's almost impossible for you to not make money if you truly have an edge in the market. Okay, next up, you also want to know what minor pairs are, or crosses. They're also called crosses at sometimes. Okay, these minor pairs are currency pairs that have USD as none of the currencies in the pairs. So if you've been trading for some time now, I'm pretty sure when you got started with trading, you were taught what currency pairs, what the currencies in a currency pair are. The first currency in a currency pair is called the base currency. So in this example, for example, you've got the Euro USD. The base currency in this particular currency pair would be the Euro. And the second currency in the pair, which is the USD, is called the quote currency or the counter currency. Okay? So the Euro is the base currency and the USD is the quote currency or the counter currency for this particular pair. To consider another example, the GBP USD, the GBP, since it's the first currency that is quoted in this particular pair, then the GBP would be the base currency and the USD would be the quote currency. But what of the USD JPY? In this case, you can see that the USD is the first currency. And so in this particular currency pair, the USD JPY, the USD would be considered as the base currency, while the JPY will be considered as the quote currency. Okay? Now, when you have a currency pair that has the United States dollar as either the base currency or the quote currency in that particular currency pair, then this is known as a major pair. Okay, most of the major currency pairs that you hear me talking about, you can see I said it's the Euro USD because it has the USD somewhere in the pair. GBP USD, it has the USD somewhere in the pair. USD JPY, it has the USD as the base currency in the pair. But then when we're talking about minor currency pairs or crosses, they have no USD at all in the pairs quotation. So currency pairs like the Euro GBP or the AUD JPY or the GBP JPY, these are all called minor currency pairs or currency crosses, okay, because they don't have the USD but they also offer very good trends in the market. So again, we come back to, we circle right back to what I was trying to tell you, okay? If you're first getting started with trading, the pairs that are usually going to be the most liquid and the most volatile and offer you the most competitive spreads and commissions, and which is the way brokers actually make money through traders, okay, are going to be the major pairs. You want to stick to the major pairs. But then if you're able to, master the game with these major pairs, and maybe you want to diversify your portfolio a little bit, and you've created other trading strategies, or you found other edges in the market, then you could expand your portfolio of pairs from just trading the majors alone to actually including some of the currency crosses, like the GBP JPY, for example, or the Euro GBP or the AUD JPY. These are pairs that I actually trade. In fact, especially the GBP JPY is one of the pairs that I tend to trade a lot. Okay, so if you've mastered the major trading the major pairs, which have the competitive spreads and they're the most liquid and the most volatile and all of that, you could also expand your portfolio by trading the crosses because they offer good trends. Okay, it's just that you need to bear in mind that most of the times their spreads are going to be a little bit higher than the spreads of the other pairs, okay, which are the majors or whatever. And also, the cost of the spreads and the commissions and swaps and whatnot is not going to be as competitive as the ones for the major pairs, okay? Because they are not traded as much as the major pairs. And then last but not least, we've got the exotic pairs. An exotic pair is usually a combination of a high volatility and high spreads, okay? An exotic pair would be something like the USD TRY. Now, why is this called an exotic pair, even though we have the TRY in the pair? This is because this is the Turkish lira, okay? And the Turkish lira is actually not, even though the USD TRY, which is the USD against the Turkish lira, or the USD against the South African rand, which is ZAR in this example, has the USD currency in the currency pair, it's not a major pair. And the reason is because the Turkish lira, obviously, is not one of the currency pairs which are considered the majors. In fact, to cut this explanation short, let's quickly look at exactly which currencies make up the currency pairs, which are involved in the, list of currency pairs which are the majors, okay? So here we have the list of them. We'll just click on any one of these results. And yep, we've got this loading. You can see them here. So the list of major currency pairs, we've got the Euro USD, which is the nickname of the Euro USD is the fiber. The USD JPY, its nickname is the gopher. GBP USD, cable. USD CHF, Swissy, AUD USD. These are the list of currency pairs which are considered as the majors, okay? We've got a couple of currency pairs which are considered the majors, but they don't include the USD in this currency pair, which these are the exceptions to the rules, okay? To the rule, okay? Which is the GBP against the Euro, Euro CHF, Euro JPY, okay? Now, we've also got traditionally, when you hear people talking about the majors, more often than not, these are the four currency pairs that they're referring to. Okay, and if you want to expand those, these are the remaining list of currency pairs which are included in these. Okay, and so because of this, when you see other pairs that are not included in this, then most of the times they either fall under the category of the minor currency pairs or the category of exotic. Exotic pairs. Okay, exotic pairs. So again, cycling back to what we were talking about. If you're just getting started, the best way you discover, or the best way to choose which currency pair is good to trade, is to stick with the currency pairs which have the most liquidity and volatility. And these are found in the combination of major currency pairs, which often include Euro USD, GBP USD, USD JPY, amongst a host of others. And if you've been able to master trading, profitable trading with these major currency pairs, then eventually, if you want to expand your portfolio, you can then transition to adding to your major currency pairs that you're trading profitably the minor pairs or the crosses. And then eventually, if you want to trade more pairs, if you still feel you need to, you can, transition to adding exotics and all of that. Okay, so this pretty much brings us to the end of this week's edition of the ITU Forex class. But again, before we wrap up the class, I would like to use this opportunity to introduce you guys to the list of bots which are traded with the ITU bots, okay, which help us to trade and earn while you're learning, okay? So we've got the ITU SBT, the ITU Gold Mine, we've got the ITU ABT and the ITU BBT. These are all trading bots or expert advisors which are designed to identify low risk, high probability trading opportunities for you. You don't need to do that manually. They will do that automatically for you, even while you're asleep, okay? They would identify low risk, high probability trade setups for you, place those trades with proper risk management if you follow our risk recommendations, and then they would manage those trades for you, okay? So if you're interested, please reach out to us in the comment section or any of our social handles, and we'll be more than happy to assist you, set everything up step by step, and get you earning while you're learning, okay? So it's always advisable for you to, as you're learning from the ITU Forex class, how to trade with profitable trading strategies that are manual in nature. You would also want to expand your portfolio, a portion or a particular sub portion of your portfolio to automated trading, okay, so that you actually diversify your portfolio and, you know, get up and running as quick as possible. So if you're interested, please feel free to reach out to us on any of our social handles, and would be more than happy to assist you, set everything up step by step, and get you up and running in as little as no time. Once again, thank you very much for taking time out of your busy schedule to attend this class, and I look forward to seeing you guys in next week's edition of the class. Go out there and crush the markets, and make sure to input what you learned in today's class. Make sure to put it in practice, okay? Decide which currency pair you're going to trade, and if you're just starting out, you're not even profitable at first, choose any one of the currency pairs which are, make sure they are in the major currency pairs, the list of major currency pairs. You could choose any one of these, the four, okay? The Euro USD, USD JPY, GBP USD, or the USD CHF, because they are the most traded. They are the most heavily traded major currency pairs. And if you're profitably trading them, you've been able to master them, then you can move on to the minor pairs or the crosses or the exotics. Eventually, you know, before you know it, you transition from keep adding currency pairs into your portfolio. But for the best conditions, at first, you want to stick to the majors, okay? So I look forward to seeing you guys in next week's edition of the class. Once again, thank you, and have a wonderful rest of your week, and God bless you all. Cheers.